Welcome to the Cultivating Business Growth podcast, bringing you bi-weekly discussions designed to help you grow your business and create the lifestyle you desire. Elevate your business with proven strategies from virtual CFOs, CPAs, and business advisors. We discuss real-world challenges solved with actionable steps that get you the results you need both in business and building the life you deserve.
Thank you for joining us for episode 175 of the Cultivating Business Growth podcast, brought to you by Willow Virtual CFO. Today, we are going to be talking about how the big, beautiful bill is reshaping taxes. And I have with me Katina Peters, my partner and CFO, and our resident tax expert here to help us understand it and learn more about the big, beautiful bill. So welcome, Katina.
Thanks, Jamie. Good to be here. Interesting to see what they're doing with the tax laws.
Yes, never a dull moment, but very confusing. Lots of articles and news about this. So we're hoping to shed a little light on it and make it a little less confusing, at least from what we know. So we're going to be diving into the big, beautiful bill today. It was signed into law on July 4th, 2025. It makes many provisions from the 2017 Tax Cuts and Jobs Act permanent, while adding brand new deductions, credits, and reforms. Why don't we just start with why is this bill such a big deal for taxpayers?
Yeah, I think the biggest thing was waiting for the bill. Like everybody's like, TCJA had all these things in it that were going to expire and change the landscape. And everybody was like, are they going to expire? Are they not going to expire? What's going on? And I will have to say, I'm very thankful that it was July 4th and not December 4th that they decided to do all this.
Mid-year instead of late year.
Yeah, exactly. Because a lot of times the late year ones, everybody's scrambling to try to, get in compliance or trying to, maximize what they can. So at least we had some better runway with this one as well. So it is a big deal because it does extend a lot of those things, and we'll get into the details there. But a lot of those benefits of the TCJA that benefited both individual taxpayers and business taxpayers have been extended. So that was really good. And then they've added some pretty interesting things as well to help taxpayers and businesses to save in taxes, not have to pay as much. So it's a good thing. There's also some additional item that you may or may not have heard of, these Trump child accounts, which I thought was a very interesting situation. I actually didn't end up hearing about them till after the bill. So a lot of times we'll hear, well, they're thinking of doing this and they're thinking of doing that. And you get a lot of, what do we think is going to happen? But then actually when it's passed, I heard about this after the fact. I was like, that's interesting. We'll have to, what is that? How does that work? So we'll get into that as well. So yeah, some interesting things happening for sure.
Great. So from a higher level point of view, what is our goal for today?
Yeah, so our goal for today is to just give like a broad overview. There's be some details in there, but more just a broad sweeping, okay, what impacts does it have? What's changed? Who's going to benefit? How can I plan a little bit better maybe for my 25 and 26 tax year? We definitely want to make sure that you're taking this information in to have some knowledge about it and taking it to your tax preparer to talk to them about it. If you have questions, obviously we're here to help as well, because a lot of these things are very situational to you and your specific business and tax situation. So just keep that in mind. But it's good to have at least a broad-based knowledge of what things are changing, what things are staying, so that you kind of know a little bit more about it.
Awesome. And we're going to talk about this from a couple of different perspectives, from the individual perspective and from businesses, so for business owners. But we're going to start with the individual side of things. So can we start with what is going to happen to the tax brackets?
Yes. So it says so we have the 2017. So rolling back to the 2017, not rolling back because they've been there, but they've come from 2017 and they're going to be made quote unquote permanent. I love those. Law or the word permanent when it comes to law, because it's only permanent till they change the law, but it's permanent according to the law right now. So we've got 10, 12, 22, 24, 32, 35, and 37%. So that's like the range from 10% up to the top end, 30%, 37%, excuse me. tax brackets are now the permanent brackets, as according to the law, until they decide to change them later. But that's where they stand for now. So we have our top end at the 37% kicks in above $751,600 in AGI. So that's a joint AGI, so married AGI, or $626,350 a single. So I kind of just like to round those off for your brain purposes. If you know you're close to the 750 mark or the 625 mark, single versus married, you might want to kind of see how that affects you and where you're at with your tax brackets, trying to get, maybe do some tax planning to get under those brackets so you're not in that high end tax bracket. And then the 24% tax bracket, kind of skipping the lower ones, it does affect some people, but a lot of more people fall into a little bit higher tax brackets. So looking at that, you're around the 200,000 marks, it's 206,700 joint. But again, I like to make things easier in my brain and just say, around 200. So then I can go look at the specifics if I know I'm close to that number, right? Because these change all the time. And then the single side would fall in that 24% bracket at 103,350. So kind of close to that $100,000 mark. So just kind of knowing where you fall. So there is a difference, just to clarify, between your tax bracket and your effective tax rate. So your tax bracket's kind of that top line. Where do you fall? How is your income tax calculated as far as what bracket you fall in? Your effective tax rate is after all your deductions and all your credits and all your things. What are you effectively paying in tax? So sometimes people have a question about the bracket, but then why are they in a different, tax rate when their, return gets all computed, et cetera. So you have a bracket you fall into. If you can stay under, those bracket cutoffs by doing some tax planning, you can save yourself some percentages in taxes, which can, amount to larger amounts of money in certain circumstances. So those things are kind of good to keep an eye on, and they are easily found. We can Google anything, right? We can go to irs.gov. We can find, what are the brackets for this year or next year. But it's a good thing to
Yes, whenever I do my family planning, I'm always like, I got to go find those brackets and what are the ranges. I need to update. I have a little calculation. I'm like, I need to update it so it's accurate now because it changes. So has there been any impact to the standard deduction?
Yes, so the standard deduction has been raised again. It was raised with TCJA and it's been raised again. So single is now $15,750. Head of household, $23,625. And married filing joint is $31,500. Okay, so there's been some pretty good bumps in that for 2025, and they will continue to bump again in 2026 as well to have some higher numbers. I won't give too many numbers out there because 26 is 26.
So this is an impact for when we file our taxes next year for the 2025.
Year. Correct. Yeah. So when you file your tax return in the spring for this year, these are this year numbers. Yeah, that we're talking about. So, so it does simplify a lot of people's tax returns to have this higher standard deduction because in order to take more than a standard deduction, you're then going to go through and itemize, which takes a little more effort. Obviously, you got to keep receipts. You got to, get all the things together to get your itemization. You're still there's definitely going to be times where itemized is going to be a better situation, but a lot of people will fall under that high standard deduction and just stick with the standard deduction. So it makes processing the returns a little easier and keeping your tax records a little easier as well. So
that is helpful. And then are there any new reliefs for individuals?
Yeah, quite a few actually. It's pretty interesting. So the kind of the caveat to that is there's a lot of around it, like phase outs around it, things that qualify and don't qualify. So,
more questions than answers probably.
Yes, and there's still some clarifications coming out on some of this as well. So we'll start with the first one, the no tax on tips. So that was a big, thing obviously on the news, no tax on tips and whatnot. So that is in play. It's up to $25,000 in tips. But then there's also the phase out side. So the phase out started at $150,000 in AGI. So, you do have that. And when it starts, you'll still get some of it as you get to the higher end of the phase outs, but that's kind of just the gist of it. So up to $25,000. Now, that's qualified tips. So then you go, well, what's qualified tips, right? So you always got this legal stuff. So on the qualified tips, it's voluntary customary situations. So it can't be, so there's a little discussion out there on, it has to be a voluntary tip. So, sometimes you go out to eat and if you have a party paid or more or whatever, on there, you must pay X% in tip.
Right.
So then is that voluntary now or not?
Yeah.
So how do we differentiate between those tips and the others? And I think they're going to probably come down to, not being as concerned about like those types of situations, but there's still, it right now it does say voluntary. So restaurants may want to change, their voluntary versus involuntary situation maybe. Yeah, and then of course it comes on the flip side. If you're the owner of the restaurant or the place that's dealing with the tips, how do you report all that, right? Too, at some point. We'll talk about that some more later. But yeah, so it has to be qualified tips, and it's specific occupations only. So they don't, want CPAs starting to take tips instead of charging fees.
Oh, look, I got a really nice tip. I'm not going to pay my taxes on. Thanks.
Yeah, exactly. So anyway, so it's going to be kind of your typical places you would tip, your restaurants, Uber drivers, things like that, whatever those tips would look like that you would normally give in a customary situation. So, but they do have a list. There's a list on what occupations would qualify for that. So you want to
and the list is out and available?
The list is out and available. Yeah, but I know.
We're not waiting for that list still?
Nope. They actually put the list out. Doesn't mean it won't change at some point, but it is out. So yes, you can look up that list. So there's no tax on tips. So it's kind of like no tax on some tips, right? It's not really all. So just make sure you know what you're doing there. Okay, then we've got no tax on overtime, as they say. Okay, so again, that is limited though. Only up to $12,500, and there's again that $150,000 AGI phase out on it as well. So
and that just means if you have $150,000 of income, you're not getting all of that because they feel like you have more money. This is helping the people on the under 150,000 end of things.
Correct. Yes. They wanted the most impact for the lower tax base. So the people that are making a little less money and wanted to help them out. So yes, it does start to phase out after that. That's correct. So, okay. So there's that there. So overtime obviously would have to be tracked and reported, etc. Okay, so then we've got the child tax credit was raised up to $2,500 per child. Still has limits and phase outs and things like that. I won't get into all the details there, but it did get raised, so that's helpful for a lot of people. And then we also have the senior deduction. So this was the big touted Social Security no tax thing. So it's actually a deduction. So it's not really, you still include it in your income and then you get a deduction. So you get an extra $6,000 per person if you're 65 or older. And there is again a phase out at $75,000. So if that phase out starts at $75,000, goes $175,000. So if you're at $175,000 income, you don't get this deduction at all. And it starts to phase out.
And as a single person, 175?
As a single person, yes, correct. Mm-hmm.
Got it.
Yeah. So there is that, but that is helpful, obviously, to not have to pay, some of those Social Security taxes that people on Social Security retirement income are having to deal with right now. So it is definitely helpful. Okay. And then we have the adoption credit is now partially refundable. So there's always been an adoption credit that you could get, but it wasn't a refundable credit. So it would only reduce your taxes, but not refund anything to you. So you would maybe lay out a lot of money and, you'd be able to, again, reduce, some of your taxes, but you wouldn't necessarily get as much help as now you can get with the refundable credit, which is nice. So, and hopefully just an extra help to those that are looking to adopt. So,
yep.
All right, and then the lots talked about SALT cap. So the SALT is the state deduction that you get on your itemized deductions, so state income tax related deductions. So it was raised to $40,000. So right now, or prior to this, it was 10. So you got a cap at 10. So if you were in a state that you paid high income tax, like New York, California, Illinois, you used to be, before TCJA came out, you could deduct those taxes on your itemized deductions. And then when TCJA came out, they limited those deductions, and that includes income taxes, real estate taxes, any taxes that you're paying to a state or locale. So not federal, just state. So now, so that kind of cut a lot of people's itemized deductions down quite a bit when they were in those higher income taxed states. So there was a big battle over the SALT cap with regards to the big beautiful bill. They were, there were states obviously with the higher income taxes wanting to lobby for their taxpayers to get a more of a deduction, and then there are states that either had no state income tax, for example, or like that's not fair, so there's this back and forth battle. So they decided to kind of meet in the middle a little bit, so it's not fully open like it used to be, but they raised it up to 40,000. Now this one is not permanent. It goes from 26 to 29 currently, unless something gets changed in the law. So it was just kind of we'll do this for a while, is where they landed when they were negotiating. So yeah.
Awesome. Yeah, that's a lot of new changes. So hopefully that will help out people that need it. What about estate and gift taxes? Is there any changes there?
Yeah, this one is there was a jump in it. So first of all, again, kind of going back to, is TCJ going to continue, not continue? What are the, because this was it was at 13,500,000 previously, and that was subject to sunset at the end of 2025 and roll back to, I believe, 5 million. So that was going to roll back quite a bit. So everybody was like, what do we do estate planning wise? So just the extension of TCJA helped, but they actually bumped it to 15 million per person now. And it's indexed for inflation to go up every year. So you would just watch for that index. But that means, if you have an estate under 15 million, you are exempt from federal estate taxes. Watch your states, because states don't always follow the federal on that. But that's a really good exemption amount, and a way for people to not have to worry about, their descendants having to pay taxes, especially on things that are not liquid, like real estate, things like that. So they would have to do fire sales or hurry up and get some money somehow out of those properties. So it gives some leeway for that, for people to be able to pass things to their family members after their death and not have to worry about estate taxes.
Yep. Awesome. So we talked a lot about individual impact of the big beautiful bill. Now we're going to move on to talking a little bit more about business and corporate tax impacts. So how are the small businesses affected?
So small businesses came out pretty well in this. Again, TCJA was nice to small businesses, and it was a lot of things, again, extended, things improved with the big beautiful bill. So the QBI deduction, the 20% QBI deduction. So if you don't know exactly what that is, it's a qualified business deduction. So if you have qualified business interest, like a pass-through, think of a pass-through. If you get a K1, if you have a pass-through, that's a good way to probably look at it. If you get a K1 from your business, it's a pass-through coming to you. This was an extra deduction that you got to take against that income that was passing through. And that's now been made, again, permanent, as they say right now. So until the law changes, it is permanent. Previously, it was a sunset provision again, and now it's been extended and made permanent. So that's pretty exciting for small businesses, because a lot of small businesses can take advantage of QBI deduction. So that was really cool. And they also had restored the 100% bonus depreciation rule. So that's been around for a while, where you're able to 100% bonus depreciate property that you're buying. Again, certain parameters you have to fall within, and phase outs and stuff. So watch that. But it's very expensive for a lot of small businesses, and it's super helpful when you're buying equipment, vehicles, things like that for your business, to help get that deduction right away and not have to spread it over the life of that piece of equipment. So it helps with the cash flow. So let's see what else we've got. Full expensing allowed for qualified structures through 2030. So that's a little more nuancy. So definitely want to make sure that you're falling into the qualified structures. Not going to get into a whole lot of details with that. I just want to make sure that you're aware of, okay, we need to look at if I'm building a structure for my business, building a building, things like that, we want to watch and see if we're qualifying and getting those full expenses on that. We've also got Section 179 limits being expanded and adjusted for inflation. So your Section 179 is an immediate deduction for equipment. So we can have bonus or we can have Section 179. So if maybe you don't qualify for one, you can qualify for the other. So those, again, allow for that full deduction, immediate deduction, promotes capital expenditures, and kind of helps with the cash flow. So that's a similar to the bonus depreciation, just works a little differently and has different rules around it. So, but good that that's been expanded further so more people and more business owners can use it. All right. And the interest deduction now includes some business vehicles. So there's some changes to the interest deduction that you can potentially take advantage of if you've got business fleets, vehicles that you're using, and you're able to make adjustments for that. So yeah, there's a few things there. Again, like I said, bonus depreciation and QBI, probably the biggest ones that will really impact small businesses, or we're looking to impact them negatively. They're kind of more rolling back and sticking around. So that's really good.
Yep. And then what's new for corporations and international rules?
Yeah, so we don't run across a lot of international in the clientele that we deal with, but just to be aware of, we do have the BEAT tax permanently set at 10.5% if you deal with that. QBIA, they're repealing limits on foreign income exclusions. So there's some things to watch out for foreign income exclusions as far as that goes. So again, we definitely have partners that we work with if you deal with a lot of foreign related taxes and things that you have to deal with there. We would be happy to help you find someone to support you in that. So we're not going to dig into it too much here just because that's not something that we deal in a lot, but it's something to just know is there. The other thing is corporate, no, that's not foreign related. Corporate charitable deductions now have a 1% floor. So a floor means you have to go over that to get a deduction. So you have a 1% floor on that. So only giving above 1% of your EGI is going to be deductible for a corporation. So making some changes there as far as what corporations can deduct. So something to be aware of as you're doing and planning your charitable giving.
Outstanding. That's great. And then any updates to energy or clean credits?
Yes. So, okay, we've got the clean electricity credits. So those are going to be looking at ending after 2027. So they've been extended again, so not falling off, but they've been extended. And the clean fuel credit has also been extended through 2029. So some of these are staggered a little, 27, 29. However, electric vehicle credit ended September 30th, 2025. So that has now gone away. But I'm sure a lot of people heard about that one on the news. It was very out there and whatnot, but something that you could still take advantage of if you did purchase an electric vehicle prior to the end of September.
Okay, so we talked a little bit about individual impact and business impact. Why don't we dive into the Trump child accounts for just a few minutes and learn a little bit more about those since they're new. Can you talk a little bit about what exactly these accounts are?
Yes, so as we said, the official name, the Trump child accounts, from our President Trump, who likes to name things after himself, as we all know. So these are very interesting. They are tax advantaged custodial investment accounts for children under 18. So basically, they wanted to make a vehicle for children to start saving for things in life and in retirement and etc. prior to turning 18. So as most of us know, as we have been saving for retirement, setting up retirement accounts, things like that, most of that all comes into play 18 or over, right? So this is something they wanted to do to kind of kickstart children into a savings mode and make a good tax vehicle to do that with. So this is for children under 18 with the Social Security number. So they have to be, have a Social Security number, citizen, etc. So it's an automatic thing that's set up for children born between 2025 and 2028. That may get extended. We don't know for sure, but that's where it starts. You also have to have a parent or guardian that is involved in activating the account. So you're still, there's still some legal things to have there. So you have to still have somebody involved in that. An interesting thing about this is that for eligible children, there's $1,000 federal seed deposit that goes in. So basically the government's going to put $1,000 into these accounts for these children. Again, doesn't start till children born in 2025. Unfortunately, my child doesn't qualify for that, but it's something to help out future children here as far as that goes. So there's that goes into it. Then you can also have up to $5,000 annually per child put into the account from anyone. So it doesn't matter who it comes from, parent or grandparent or whoever. Employers can also add this as a benefit. They can add $2,500 in as well to the child's account. Well, that's pretty cool, pretty interesting benefit to have. They do require that those funds are put into U.S. stock index funds or ETFs. So there's some requirements about how it's invested for them. So the contributions, now we'll get to the tax part of this. So contributions are after tax. So you don't get to deduct it. So if you're making a contribution for your child, you don't get to deduct it, or it doesn't affect any taxes. It's just savings money that you're putting away from them. However, the benefit is that the growth of these accounts is tax deferred. So they're tax-free withdrawals. So when they take things out later in life for education, a first home, there's a list of things that qualify. It's not just education, like some of these like 529 plans, etc. When you take money out of those accounts, or when your child does, then it's tax-free, so that you don't have to pay any tax on that. So that's the benefit of just earning this money over time, and you're able to get it to grow.
Is it tax-free only for specific uses, or for any withdrawal?
No, there are specific uses, and there is a 10% penalty for non-qualified withdrawals. So you want to make sure that you're looking at the qualifications of what all you can use these funds for. But they're mostly geared towards kind of like kicking off your young adult life, I guess you could say, like buying a home, getting education, things like that. So I want to make sure, and of course those could change over time, so you just want to watch those. But it's a pretty good to have an account that can grow tax-free, especially if you're talking about, someone just born till, the age of 18, 20, whatever the case may be. That's a lot of growth that can happen.
Well, and we always talk about with 401ks how important it is to start early and how it compounds. So like the earlier you can start, the better. And especially, even if it's a small amount of money, it can really compound. So starting really early can be a huge benefit. What happens when the child turns 18?
Yeah, so when they turn 18, obviously now you're not the custodian anymore. The guardian of the account is the parent, but it will convert into an IRA account. But it does retain, again, those tax-deferred, there's tax-free withdrawal advantages, so that doesn't change. But it does become like an IRA, which is nice because IRAs are very protected by law. So it's a protected account for the child, now adult, to have, and again to just continue to grow and go from there. So for, like you were talking about, some of the growth things, for example, if we're looking at how much these accounts can grow, if we have max contributions going in starting in 2025 going forward by age 18, the max contributions would add up to like $303,800. So that would be what would be contributed. And the estimate going up as far as growth and whatnot goes through that is $1 million by age 28. So they could have a pretty good amount of savings for most 28-year-olds, right? I don't know too many 28-year-olds.
For all 28-year-olds, I'm pretty sure. We hope to have that by retirement age, right?
Right. Yeah. So I mean, that if they're good, and maybe they don't spend it on a first house or whatever, they just let it continue to grow and be invested wisely, then that's a pretty good amount. So if with only the $1,000 seed, they would be at $5,800 by 18 and $18,100 by age 28. So still an amount of growth. So, but obviously you can see, adding to it as much as you can. If you can max the contributions, and then you're gonna get much more growth by that age. So still good either way, I think.
Yeah. Save early and often.
Yes.
It's not fun. I didn't want to do it when I was younger. Luckily, my parents motivated me to put money in my 401k. And so things you don't want to be thinking about when you're young, but
Right.
eventually you get older. You're glad and grateful that you thought about that a little bit.
Yeah.
Okay, so moving on to kind of our last segment before we wrap up. Just clarifications and pending guidance. I know there's still a lot to unravel as far as the specifics of all of these, but what's still unclear from the IRS?
Yeah, so there's still some clarity that needs to be provided around the tip and overtime deductions. A lot around how is the reporting going to work, how's withholding going to work around these things. So for 2025, employers are going to be allowed to do some estimating in their reasonable estimates of things with regards to that, because maybe they didn't, track certain things under the law because they didn't need to previously. But as far as, then again, as far as withholding, are they going to still withhold on these things that are not taxable, or do they reduce the amount of withholding that goes against these things because they're not taxable? And there's just a lot of obviously questions around that. So they're still working on the guidance for how to treat those as an employer, and of course what the impact's going to be on the employee. So those things are kind of in flux a little bit. And like I said, there's still more to come out too with regards to how are we handling the 2025 employer side filings, like what's going to be provided on the W-2, et cetera. So there's still some guidance coming on that as well.
And then how are employers handling the 2025 changes?
Well, they've, again, I think most of them are doing a little bit of wait until we hear more. From what I've seen, they're kind of just waiting for more direction on what to do and how to do things. Some systems are already tracking tips, tracking overtime. They have separate ways of looking at that. I would think probably at least most of them do some sort of tracking of overtime and tips at this point, already, but maybe just not spitting it out in the reports the way that it would need to be spit out at the end or things like that. So, but if not, again, sounds like currently the IRS's guidance is that you can use reasonable estimate methodologies, whatever that looks like, for your business. So, yeah. We're also looking for the, it says final list of eligible occupations for no tax on tips. There's a list. This could be subject to change, so we're still just keep that in mind. But I think you're probably, if you're in an occupation or you know somebody in an occupation that's usually tipped, it's likely going to be eligible on that list. So, yep.
All right.
Still to come out on the Trump accounts administratively, and some phase-ins for depreciation in Section 179. So, those are more nuancy for us tax people to keep track of for you.
Leave it to you guys to figure out.
Mm-hmm.
All right, well, we are going to wrap it up then. If we can get, what are your your key takeaways of what our discussion was here? If this is the only thing that people remember, what are those 3 things?
For sure. I think a big thing is to breathe easy, that things look fairly similar to last year as far as the extension of TCJA goes. And if not better, right, for you as a business owner and an individual. So I think that's the main thing to know is like, okay, we still got the same kind of tax landscape with some extra benefits and perks there. So that's, kind of the first takeaway that I would say that you'd want to consider as far as that goes. And then looking at these kind of new opportunities, if you can qualify for Trump accounts or senior deductions or better business deductions, kind of being aware of those and talking with your tax preparer. As we've talked about a lot in the past, it's the tax planning. Tax preparation is important. It's important to be accurate and do it right, but tax planning is key. You need to be doing that ahead of time. This is about the time of year well, it's really a couple times a year, I should say. We're recording this right now, this time of year, we're at the end of October, that we look at it in November, but we also look at it in July. You know, for all our businesses that we work with and all our business owners that we work with, you know, July and November-ish, that's always the best time to kind of be like, okay, where's our mid-year tax plan? What do we need to change? What do we need to pivot? Are we doing what we expected or not? And then our November timeframe is to any final tweaks and to know exactly what we've got going on heading into year end. So I want to make sure that we're doing
Yeah, I think we should stress that too, because as a non-tax preparer, working with my clients, I know how important it is and how easy it is to put off and not think it's important enough to do, and like, oh, I don't want to spend extra money on this. But usually the information you gain during those tax planning sessions, especially if you have bigger changes to your business, suddenly you're very profitable, but you weren't as profitable, you sometimes forget, I owe a significant more amount of taxes and I didn't plan for that. So I highly recommend everybody stopping and just looking at your financials in July, making sure your CPA or tax folks are looking at it, getting an estimate for what you're going to owe for taxes. I still see way too many business owners finding out April, 10th what they owe, and they're stunned about how much money it is. That should not be happening. You should be on it. Your tax folks should be on it. You should have conversations. At a minimum, you should know by November the year before, so you have time to plan. And if you can know earlier in the year, then you're planning throughout the whole year to save up for those taxes. So I can't stress that enough too. I think that's really important.
Absolutely.
So what can our listeners do next?
Well, I think we just covered most of it. Make sure you have that tax plan in place. Yes. That's the big one. Make sure you're talking to your tax advisor, or make sure they're talking to you. This is something that as a business owner, especially like you said, Jaime, it needs to be addressed at a minimum of twice a year. So I want to make sure that you're having those plans put in place.
Awesome. Well, thank you for joining us today to talk about the big, beautiful bill. Keep that momentum going, and we will see you next time.